Lizzy, walk us through what's made the rate cut expectations, the messaging change, and it's been pretty dramatic, hasn't it, since the last meeting?
An absolute about-face, Tom, since we were last in Frankfurt. It's an unusually short period between meetings, and we haven't had a whole lot of economic data in the meantime. So to tell you what they're focusing on, you mentioned the inflation story, back below 2% for the first time since 2021. But on the flip side of that, you've also had these business surveys showing concerns about the growth outlook, particularly in the private sector. Put that together and market expectations really shifted towards a rate cut today, almost fully priced. And what's interesting is that the Governing Council hasn't really done much to bat that away. In fact, most of them have endorsed this. The only member of the Governing Council who's actively, publicly arguing against a cut today is the Slovakian Central Bank Governor, Peter Kazimir, although, of course, there could be more hawks behind the scenes. But that means that now the focus in the press conference will turn to the rate path ahead. And at the moment, the expectation is for faster cuts to a deeper, lower level.
Well, talk us about that projection then, going ahead, beyond this meeting, where, as you say, markets are fully pricing in, almost fully pricing in this 25 basis points. What is the path ahead for the ECB, given inflation at 2%, given the softness in growth? How much tension is there going to be within the FOMC, or I should say ahead of the ECB, of course, not the FOMC, but that's part of the mix as well, where the Fed goes, in terms of the months ahead, the decisions for this ECB as we project into 2025?
Well, it's an interesting contrast, isn't it? The dual mandate of the Federal Reserve and the ECB still having to balance the downside risks to growth and the continued inflationary pressures. In terms of the path ahead, our survey of analysts expects cuts at every meeting all the way to March, and then another couple of cuts in June and December. So that would take the benchmark rate to 2%. Now, you can debate where the neutral rate is, the rate at which interest rates neither stimulate nor restrict the economy. But all of this is based on the data. On the one hand, if you look at the labour market, it is showing signs of easing. Look at the corporate story. Companies like BASF and ThyssenKrupp offloading staff. Volkswagen significantly looking at closing German plants for the first time. And yet, you still have unemployment at a record low. So wages growing at a healthy clip, keeping up that inflationary pressure, but then the ECB having to manage these downside risks to growth. And even just last night, Christine Lagarde flagging the geopolitical tensions in the Middle East, the political tensions around the US elections, so much uncertainty, which means overall, in this press conference today, I am sure Christine Lagarde will continue to emphasise the need for caution and, Tom, again, the need for data dependency.